coming wave of distressed sellers is the story people keep hearing about housing, but the mechanism behind it is much more subtle. Our strategy focuses less on dramatic predictions and more on how pressures build through the system over time. When affordability breaks, housing does not correct all at once. It usually begins with something quieter. Transactions slow, price cuts increase, and demand begins to step back, even while listings remain elevated. The common narrative says the housing market only needs lower interest rates to recover. But the reality is that housing affordability is not just about mortgage rates. The payment people face includes the home price, the mortgage rate, property taxes, insurance costs, maintenance costs, and access to credit. If one piece improves while the others worsen, the overall payment burden does not normalize. That is why you can see mortgage rates decline while demand remains historically weak. Our strategy looks at this through a sequence of mechanisms. The first mechanism is affordability compression. When ownership costs remain significantly higher than renting in most markets, buyers delay decisions. Instead of rushing into purchases, many households extend leases or remain on the sidelines, waiting for conditions to reset. That behavior alone can keep housing activity subdued for long periods. The second mechanism is what some analysts describe as a shadow transaction layer. Not every property exchange is happening through the visible listing systems. Some transactions are occurring through seller financing, private credit, or off-market deals. This means the official data can lag what is actually happening underneath the surface of the housing system. The third mechanism is demographic supply. Housing supply does not only come from new construction, it also comes from ownership transitions. As large demographic groups age, properties can shift hands through estate transfers, inheritance, or the sale of rental portfolios. These transitions are not particularly sensitive to interest rates. They are driven by life events and long-term ownership cycles. If you are finding this type of mechanism-driven analysis useful, consider subscribing so you can follow how these signals evolve over time. Our goal is to help viewers understand how market structures actually function, so you can interpret financial headlines with more clarity. Within the Our Strategy framework, housing often behaves like a slow-moving credit asset. It usually reprices through time before it reprices through price. That means the first signals appear as slower sales, longer listing times, and more concessions before large price adjustments become visible. Right now, we interpret housing conditions as late phase 2 pressure within the broader cycle. That means the system is experiencing compression, but not yet the type of forced liquidation that defines later phases. Our current base case places roughly a 60% probability that housing remains in this slower compression regime over the next several months. If pressure increases, the next stage would involve broader distress listings and tighter credit conditions. In that environment, price discovery accelerates because forced sellers become the marginal price setters in the market. That does not require a dramatic collapse everywhere. Housing markets tend to move unevenly across regions as supply and demand rebalance. The signals we watch for confirmation are relatively straightforward. We monitor whether price reductions are spreading across more markets, whether distress listings begin rising after temporary seasonal income support fades, and whether credit availability continues tightening for new borrowers. A brief note before we continue. This discussion is for educational purposes and reflects a framework for analyzing market behavior rather than financial advice. Another important signal is the relationship between rents and ownership costs. When rents are declining or stabilizing while ownership costs remain elevated, the incentive to buy becomes weaker. Over time, that pressure can shift bargaining power toward buyers and gradually reshape price expectations. The disciplined way to interpret these developments is to focus on mechanisms rather than headlines. Housing clears when the payment burden clears. That clearing process can occur through price adjustments, income growth, financing changes, or some combination of all three. Our strategy avoids making precise predictions about exact price levels. Instead, we track the sequence of signals that indicate whether housing is still repricing through time or beginning to reprice through price. When those signals align, the direction of the market becomes much clearer. Understanding that sequence allows observers to move beyond the simple narrative that interest rates alone determine housing outcomes. The housing market is a system shaped by credit, demographics, income growth, and cost structures that evolve over time. When you step back and observe those mechanisms together, the picture becomes less about sudden collapse and more about gradual rebalancing. And that is often how large financial systems actually adjust.